Right now, as of 10:30 a.m. Eastern on this Monday, November 10th, 2025, the stock for Bitfarms Ltd on the Toronto Stock Exchange, which many Canadian investors watch, is trading at $5.14 Canadian. It's pretty flat, down just a single cent, or about 0.19%. And that's the first expectation. The market seems to be asleep on this stock. Just a quiet day, with the stock barely moving. But that expectation is immediately shattered when you look at the U.S. listing, the one that trades far more volume on the NASDAQ under the ticker BIT. As of 10:33 a.m. Eastern, that U.S. stock is at $3.62 USD, and it's down 1.09%, or about 4 cents, on significant volume of over 13.7 million shares. This isn't a stock that's asleep. It's a stock that is seeing clear divergence and heavy trading activity. This disconnect between the two listings is the first clue that the market is deeply unsettled and uncertain about what's coming next. The common belief, the simple story, is that Bitfarms is just a proxy for Bitcoin. Bitcoin moves up, Bitfarms moves up, but with more volatility. It's what new investors look for when they start online investing. They want simple exposure. They see it on their Robinhood app or their SoFi Invest platform and buy it as a simple leveraged bet. The expectation is that you're buying a digital gold miner. The reality, however, is that this company is in the middle of a radical, high-stakes identity crisis, and this Thursday is the first major test of its new self. This Thursday, November 13th, 2025, Bitfarms is set to report its third quarter earnings before the bell. This is the entire reason the stock is treading water today with such heavy volume. All the activity you're seeing, whether it's small-scale buying of Robinhood fractional shares or massive block trades being executed on the Interactive Brokers platform, is all just positioning ahead of that report. The market is holding its breath. The general consensus expectation is for a loss of about 2 cents per share. This is actually a significant improvement from the 9-cent loss they posted in the same quarter last year, so the market expects progress. But here's the reality check. The headline earnings per share number is almost a distraction. It's not what the serious analysts, the ones managing funds at Fidelity Wealth Management or advising high-net-worth clients, will be looking at. They will be tearing through the management discussion and the cash flow statements for two things, and neither of them is the EPS. First, they'll be looking for the all-in cost to mine a single Bitcoin. After the last halving and after Bitfarms' massive acquisition of Stronghold Digital Mining earlier this year, this is the only number that matters for their core business. If that cost isn't dropping, they're not competitive. Second, and this is the big one, they'll be looking for any hard numbers on the company's new high-performance computing, or HPC AI initiative. This is the part of the story that the simple market narrative has not priced in. Earlier this year, Bitfarms didn't just buy Stronghold. It also strategically sold off its site in Iguazu, Paraguay. This was a deliberate, massive rebalancing of their portfolio away from geopolitical risk and into North America. But it wasn't just about mining Bitcoin in the U.S., it was about acquiring infrastructure, specifically low-cost power infrastructure that could be diversified. The company has been signaling a pivot, suggesting they will use this infrastructure to service the exploding demand for HPC and AI data centers. This is the narrative they are selling. It's a move to change their story from being a volatile miner, like so many others, to being a stable digital infrastructure company, something that might be valued more like a utility or even, in the most bullish case, a component of the AI boom which has sent NVIDIA stock into the stratosphere. This is a profound shift. It's an attempt to decouple their future from the day-to-day whims of the crypto market. This is not a stock for a passive, intelligent portfolio. This is the definition of an active, special situation investment. The division this new strategy has created is perfectly reflected in the analyst ratings. When you look at Bitfarms on many investing sites, you'll see a strong buy consensus, but the price targets are all over the map. Some analysts have targets as low as $2.57, which is significantly below where the stock is trading right now. Others, looking at the potential of the AI pivot, have targets as high as $6.63. This isn't a small disagreement, this is a fundamental divide. The bears see a company taking on debt, like the recent $500 million convertible notes offering, to chase a new, unproven business model, all while its core business of Bitcoin mining faces relentless margin pressure. The bulls see a company brilliantly using its one true asset, its expertise in securing cheap power, to diversify its revenue and unlock a valuation that's multiples higher than what a simple miner could ever command. This is the kind of setup that makes or breaks a portfolio. It's not a safe, stable Fidelity ETF's holding, it's a binary bet on management's execution. This is why the current online investment environment can be so tricky. An investor using the Fidelity mobile app to make a trade might see strong buy and jump in, not understanding this deep underlying conflict. Someone else might be using a SoFi robo-advisor, which would likely never touch a stock this volatile. The self-investing crowd, the people who open an individual brokerage account and do their own homework, are the ones living in this tension. They're looking at their Fidelity brokerage account, reading the reports, and trying to decide which reality will win. Is this Tesla stock in 2018 when everyone said it was just a car company going bankrupt? Or is it a flash in the pan? The answer will be found in the details of Thursday's report. The stock's behavior today, with its 13 million shares traded, tells you that the big players are placing their bets. This isn't the retail crowd that piles into Robinhood crypto. This is institutional indecision. This AI pivot is the whole story. It's the ultimate test of the expectation versus reality framework. I want to know what you think. Comment below whether you think Bitfarms' move into HPC and AI is a brilliant pivot or a desperate distraction. Let me know your take on this strategy. For those new to the name, Bitfarms' business model was simple. They were a global Bitcoin self-mining company. They built huge data centers in places with cheap electricity, like Quebec with its abundant hydropower and Argentina. They filled them with specialized computers and printed Bitcoin 24/7. Their profit was the difference between the price of Bitcoin and their cost of power. But that model is now in flux. The acquisition of Stronghold and the pivot to HPC and AI means they are no longer just a mining company. They are, in their own words, an energy and digital infrastructure company. This means they see their power agreements as the asset, not the miners. If they can make more investment return by leasing that power and infrastructure to an AI company than by mining Bitcoin, they will do it. This is a far more complex and, potentially, far more valuable model. It's what differentiates them from so many other miners that investors might see listed on SoFi stocks. So as we look to the future, the catalysts and risks are completely redefined. The old catalyst was simple. Bitcoin's price goes up. That, of course, is still a massive tailwind. If Bitcoin continues to climb, it lifts all miners, and Bitfarms will benefit. This is the simple thesis, the one that's easy to understand. But the new catalyst, the one that represents the deeper reality, is the successful signing of an HPC AI client. The moment they announce a non-crypto revenue stream of any significance, this stock will be reevaluated by the entire market. It will draw in a new class of investors, the ones who buy Apple stock for its stable services revenue, not just its iPhone sales. It would prove the new model works. But the risks are equally profound. The old risk was Bitcoin's price crashing. That risk also remains. A crypto bear market would be brutal. But the new risk is execution. What if the Stronghold integration is messy and more expensive than projected? What if their new U.S. power costs aren't as low as they hoped? What if the $500 million in debt becomes an anchor that drowns them during a crypto downturn? And what if the entire AI pivot is just talk, a narrative to prop up the stock, with no real contracts to back it up? If earnings on Thursday are silent on HPC progress, the market will punish the stock severely, assuming the pivot is failing. This is why this is such a fascinating setup. It requires more than just basic investment help. You can't just throw this into Schwab Intelligent portfolios and hope for the best. This is a stock that demands you pay attention. The tools available, from the professional-grade interactive brokers trading platform to the clean interface of SoFi or Fidelity, all just provide access. They don't provide the analysis. The difference between Fidelity mutual funds, where a manager makes these decisions, and this kind of self-investing is night and day. This is active, high-stakes, and event-driven. It's not for a passive Fidelity IRA account that you check once a year. So as we watch Bitfarms' two listings, the sleepy Canadian one at $5